is the Director of Education and Partnerships at SASB, where he identifies opportunities for professionals in finance, investment analysis, and sustainability to benefit from SASB's research on material ESG factors across the 77 industries. In doing so, he oversees SASB's membership, conference, and education programs, as well as licensing and the SASB Navigator. Nicolai has delivered invited presentations on SASB material to university-level classes, as I mentioned, including to my own. Before joining SASB in 2013, Nicolai had business development and operations roles in the private sector and higher education. He holds a bachelor's degree from Emory, and with that, I'm going to turn the floor over to Nicolai. Nicolai, thank you for joining us today.
Thank you, Ira, and thank you for including me. And it's such a privilege to be able to share the work that we're doing with educators who are really at the forefront of thinking about how sustainability can be used by students, by future business leaders, and thinking about this kind of big unknown as to how can sustainability be incorporated into various curriculums. So hopefully in talking about SASB's work today, it can help inspire you and provide you with some information and resources to incorporate and further inform the evolution of your own work and your own curriculum. So the time that we'll be spending today is going to really cover the current challenges with sustainability and ESG data, why SASB even is useful and kind of a value add in the market. And we'll talk a little bit about what we do to support that value proposition. And then, as Ira mentioned, really dig into the architecture and framework for our work and how the standards get developed. And then I'll share insights and resources that you can use in your classrooms. So to really begin, SASB can only be understood in the broader context of how sustainability is being used and incorporated in the capital markets. And this kind of busy slide here is meant to show that there's a range of different organizations doing a range of different things in thinking about how sustainability can inform investor decision-making and corporate strategies. So that's really SASB's area of focus. We look at how companies and investors can make more informed decisions using material sustainability information. So there's certainly a range of applications of sustainability outside of that context, but that specific corporate investor context is our use. And there's a number of different types of activities and initiatives and programs that look at that space. And on the slide are just a small segment of them, focusing on a range of different applications. But despite the fact that you have a plethora of organizations looking at this, there's this disconnect between how investors and companies see corporate sustainability efforts. And so one of them was surfaced a few years ago in this Accenture survey, where CEOs were asked to what extent they thought their company was approaching sustainability from a competitive advantage standpoint, as opposed to just cost reduction or brand building or something like that, but actually something that would help them succeed as a business. And 80% of those companies thought that they were doing it that way, but 14% of institutional investors, not necessarily, you know, Mr. and Mrs. 401k, but the big institutional investment firms, the pension funds, the asset managers, the hedge funds, et cetera. Among that audience, only 14% thought that the companies were doing that. So there's this big gap in how companies and investors see corporate use of sustainability. That's reinforced in a PwC survey from a couple years after that, where 100% of companies were confident in the quality of sustainability information or ESG information that we'll be using interchangeably today, but only 29% of investors who were looking at that information had confidence in the quality of it. So, and there's multiple other kind of surveys and studies that I could point to that that illustrate this gap in the market between investor sentiment and corporate sentiment along the same question of sustainability information. One of the reasons that's becoming increasingly a challenge and problem is that investors are increasingly expecting and looking for sustainability information to make decisions. Not that it's the only piece of information they consider, but sustainability data is starting to add to the current data set that an investor considers when either making a buy or sell decision, or if they are invested in a whole range of companies because they're invested in an index, how can they engage with the company and have dialogue about improved performance, since they don't necessarily have the option to buy or sell that company. They still have an ownership stake and they still can engage in productive dialogue. The PRI, I'm sure many of you know, is probably the most visible display of investor interest in sustainability information, the PRI, for the Principles for Responsible Investment, where all of the signatories, they've got over 1,500 signatories representing about half of the assets under management around the world, commit to thinking about sustainability and ESG information in investment analysis and decision making. So there's this clear demand, but these challenges in uptake of the information because it is not consistent or standardized. And that's one of the reasons that you see this kind of corporate investor gap. The other challenge that faces the market is that companies feel overwhelmed by a lot of different requests for information. GE a few years ago said that they had 650 different requests for information, that they didn't necessarily respond to all of them, but just trying to even sort through which ones to respond to and which ones not to respond to find data to be able to respond to these requests, which every request was slightly different. So you didn't necessarily collect data once and get to report that out multiple times. You'd have to almost do it on a one-off basis. Proved a very inefficient use of time and resources. And there's other indications more across many different examples of companies that feel burdened by the variety of information requests for sustainability. And when they have so many different types of requests, they can't effectively respond to all of them or even many of them because they're being pulled in too many different directions. But this is also increasingly important to companies, not just investors, because the value of companies, at least public companies, is increasingly dependent on information beyond the financial statements. If you look at the 70s, when our current accounting guidance and the SASB that sets the accounting rules in the US was established, over 80% of a company's value on the S&P 500 was based on tangible assets, was based on the information you could capture in the financial statements. But that has completely flipped to just a few years ago in 2015, over 80% of a company's value is based on intangible assets. Information related to brand and customer behavior, sustainability is part of that. Many other governance. There's a lot of things and information sources beyond just the financial statements that are impacting a company's value. And so sustainability is not only of interest to investors, but of interest to companies, at least those that see the connection to their financial performance and their value on the market. So it's an increasing importance, but it's of inconsistent quality, inconsistent views around to what extent this is being tackled as a route to competitive advantage, among other areas. So important, but not necessarily broad traction as to how to do it and handle it. And that's where SASB is intended to support the market, because you have a broad range of ways in which companies are reporting sustainability information. This is just one of literally hundreds and thousands of examples. If you're looking at an alcoholic beverage company They clearly depend on water to create value. And excuse me, if you look at recent regulatory filings from Molson Coors and Diageo, there is dramatic differences in how they report their dependence and use of water. Molson Coors talks about how water is important, and the inability to access water would affect their brewing operations and could impact their business and financial results. It's a very generic language. It's what's called boilerplate information. Diageo, on the other hand, talks about concrete ways in which they've reduced water use, they've increased water efficiency, and how in water-stressed regions, they have an even better mitigation of water risk, and how they're ultimately working towards a target to previous performance. So it's difficult for anyone, the companies, the investors, anyone, to be able to accurately compare and assess how companies are managing sustainability when the ways in which they're reporting it can vary so widely. What you ultimately would want to see for sustainability information to be useful in the same way that financial data is you would expect to see primarily data, numbers, quantitative data, and that it should be reported by a range of different companies within the same industry, so you compare who is leading, who is lagging, and do that for a set of really important material indicators that are likely to impact the performance of the company. So SASB envisions a world where any investor, whether it's Mr. and Mrs. 401k or a big asset manager, can pull up a data set on a range of companies they're looking at and be able to assess how a company is managing its water use, or how it's managing employee health and safety, or how it's managing systemic risk management or corruption and bribery, or things like that ultimately impact that business. And so SASB's role is to make that possible by creating the standards that enable consistent and comparable data in the market. So we are an independent 501c3 nonprofit that is squarely focused on working with companies and investors to identify what are the issues that impact a company's business model, and what are the metrics, the KPIs that can be used to assess performance so that companies can report that data, and then the market can analyze that information and price it into their investment decisions or their corporate engagement efforts. And so that is how we develop those standards, and the process by which we go about that is what we'll spend a little bit more time talking about. Ira did a great job capturing some of the key tenets to our work. And so I want to break these kind of 6 elements into 3 categories, or 2 categories, the top half and the bottom half. The top half means that SASB is really focused on what's material. What is the information that most moves the needle? And what is the information that is decision useful? It's useful for decision making by companies and investors, but is balancing cost demands and is not overly burdensome to collect a report. So the information that we're focused on is information that's material, decision useful, and cost effective. And to identify that information, we have an approach that is industry specific. Every industry is slightly different, and I'll explain that in a little bit more detail. We use evidence to be able to identify what we use evidence as a part of our approach to identify the material information. And ultimately, our entire approach is informed by the market, working with companies and investors who are working in this every day. So let's walk into a little bit more detail in those different components. So when we talk about material information, when it comes to sustainability, that term can encompass a broad range of information. It can encompass everything from corporate philanthropy and employee volunteerism to energy efficiency at a software company's data centers. Sustainability can be a very broad concept. And so SASB's focus is really on the slice of the pie, the sustainability pie, that is likely to affect the financial performance of a company. That is our scope of reference, and intended then to support investor decision making. All of the other types of sustainability information that may not directly impact financial performance are tackled very capably by a number of other organizations like the Global Reporting Initiative, GRI, as well as others. And we find that it's very helpful to identify where SASB has a narrower focus than some other organizations that may have a broader focus, and that they can still be complementary. And it's not one or the other, but that it's one serves different audience needs, different purposes. So let's talk about this evidence-based approach that I also mentioned, that in being able to identify information that is likely to affect the financial performance of a company, we look for two primary pieces of evidence: evidence of investor interest and evidence of financial impact. Is there evidence that investors would incorporate this information into their analysis? And is there evidence that this information or management of a particular sustainability topic has a financial impact? And then for cost effectiveness, one of the ways that we think about this is that in thinking about how companies already report information to investors, primarily financial information, they can incorporate sustainability information when it's material into those same processes. So they can leverage existing processes, they can leverage existing oversight from the board, from the CFO, with the internal audit function. There's kind of well-established processes within companies to collect and report information. And sustainability can simply be incorporated into that. So that's one element of thinking about cost effectiveness. There's other elements which I'll talk about, but it's intended to show that if you think back to the fact that companies are increasingly valued on more than just their tangible assets, much more often, companies can incorporate that information, sustainability information as well as other information, into their investor communications, so that it's not just the financial statements, but that it's a package of information that talks about how the company is managing its performance. And SASB standards are designed to sit alongside what you might get out of financial reporting standards. And ultimately, to be able to ensure that we are plugged in and informed by the market, we work with a broad range of companies and investors. Some of our biggest supporters, and I'll show kind of some broader numbers, but some of our most dedicated supporters on the investor side have joined our investor advisory group. And they help ensure that they are communicating to companies the value of standardized sustainability information that is consistent with SASB standards, but is ultimately focused on looking at how a company manages material issues related to its business. And so we are very intentional in balancing a range of different investor types, not only from the big players like BlackRock and Vanguard and State Street, the three largest, but also much smaller firms like Domini and Calvert and Walden that have a long history in sustainable investing. We have pension funds, state treasuries, we have asset managers, we have US, we have Canadian, we have European perspectives. So it's important to us to really make sure that we're balancing a range of different views. We have companies focused on public equities, we have companies focused on debt and credit. And we also have companies more focused on private equity. So there's a range of different ways in which this information can support investors. It's important for us to be plugged into those perspectives. And just to show how serious this is, all of the firms that have joined our investor advisory group have committed high, senior level investment decision makers, whether that's a chief investment officer or a president or CEO, an executive director, a head of equities, those sorts of things. Very committed senior participation in this work. So in talking a little bit more about the detail of our standards development process, we're guided by our conceptual framework, and the conceptual framework's available on our website for free, and really outlines where we see sustainability standard setting to support both companies and investors. But it's really captured pretty nicely in this graphic. And you'll notice some of the information that we talked about earlier. At the top are the three elements of information: material, decision useful, cost effective, that I showed earlier. And then at the bottom is our approach: evidence-based, industry-specific, market-informed. And so the middle really looks at how we zero in on this. Ultimately, we have topics like greenhouse gas emissions or labor relations. And for every topic, you have metrics like, scope 1 greenhouse gas emissions, or percent of your workforce that is unionized, that actually reflect either quantitative or qualitative data. And so we have criteria for being able to select topics that are likely to affect value creation, can actually be affected by companies, that they can actually do something about it, that is relevant to an industry, but that the metrics are neutral, that they aren't biased or favored in one way, that they are useful for decision making, that they allow for fair representation of a company's performance, that they can be audited or assured that they're verifiable. So this is really the work that guides our standard setting. And we start with those standards in looking at a range of broad sustainability categories, things like greenhouse gas emissions and air quality, but also human rights and community relations, employee health and safety, product packaging, critical incident risk management. This is the universe by which we consider our work, and that was within scope based on our conceptual framework. And in looking at these issues, we then have this process to zero in on what are the topics and metrics that would be useful for standardizing sustainability information in the markets. And so we start that process by doing industry-based research, looking for evidence of financial impacts. We also look actually for evidence of investor interest. This is something that we did much earlier on when we were doing the provisional draft work of our standards. We then took our research and got market feedback. Initially, we had industry working groups. Then more recently, we've had in-depth consultations with companies and investors, which I will explain in a little bit more detail. We then vet the findings of both our research and the market feedback with our standards board, which is a independent board of oversight into how the standards are set and the process by which we incorporate market feedback. We then publish public comment versions. We expose our thinking to the public and post them on our website, and have a 90-day period for anyone to be able to comment, which then leads to a final revision process and approval to get to our standards, which have an average of 5 topics and 13 metrics in the provisional phase. We are about to publish the final kind of version 1.0 standards in August. And from there, we will then basically start back up at the research. There are some topics that are on our research agenda that we haven't been able to form a clear hypothesis for yet. So then we'll get more, we'll try and form a clear hypothesis. We'll get more feedback. We'll vet that with our standards board. We'll expose for comment. And there will be a constant process over a 3-year cycle to keep the standards revised and in step with how the market's evolving on these issues. I mentioned that we are very industry specific because ultimately, if you think about these sustainability issues, they vary by industries. The sustainability issues that would affect a bank, a commercial bank, for instance, are much more related to their selling practices, the risk they have in their portfolio, how they make financing available to broad sets of the population and not just those who maybe have accounts. There's a whole set of the population that's called unbanked. So how are banks making their services available to the entire population? And those issues are quite different than an automobile company, which when you think about sustainability for an automobile company in terms of what is most likely to have a material financial impact on the business, it's issues related to energy efficiency, safety, labor relations, since it tends to be a heavily unionized industry. So every industry has a slightly different character when it comes to the sustainability issues that would impact its business. And so we have to get perspectives from all of those industries. And so this is where I said that we work with both companies and investors and other market intermediaries, from consultants and accountants to academics and other researchers and nonprofits, to really get a broad set of inputs into how we develop the standards. So for the first 4 years of our work, we had industry working groups for every industry, which included over 2,800 participants, balanced between the corporate investor and public intermediary views. We also had multiple rounds of public comments, which got nearly 200 letters. And then over the last 2 years, we've had the more in-depth consultations with companies, industry associations, analysts, and another round of public comment. And moving forward, we will have sector advisory groups that have 3-year terms that are involved in helping provide ongoing feedback on the quality, the usefulness, and potential changes to the standard. So it's really important to our work that we involve the market as much as we can. And it's also important that when we define what is ultimately going to be included in the standards, that there's this focus on the financial impacts of sustainability. And we categorize financial impacts in 4 broad ways: impacts to revenue, impacts to costs, impacts to assets and liabilities, or impacts to the risk and the cost of capital. And then those can be subdivided into different types. And sustainability topics tend to have different types of financial impact. So some sustainability topics impact demand for your products and services, like if you think of increasing demand for health or health-like products in the food and beverage industry, and decreasing demand for full-calorie beverages and snacks. Whereas you can also have impacts to revenue in thinking about long-term growth. And if you're a software company or you're a media company, having a diverse workforce helps you develop products and communicate those products and services in a way that reflects the global audience base that you're ultimately serving, and so on and so forth. So different sustainability topics can have different types of financial impact, and for us to be able to include anything in our work within the scope of our conceptual framework, it really comes back to where there's evidence of this financial impact. And luckily, because these issues are increasingly infecting companies' value, there are many, 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 many examples where this is true. And you often read about these when they go wrong. And these are kind of the headline risks that you can see. In the auto parts industry, it's product safety. There's been huge airbag problems recently, whereas in services industry, there's professional integrity in thinking about how their services are provided, whereas it's fuel economy in the automobiles industry, so on and so forth. So all of these items, when they're managed poorly, can end up as headline news, and that informs the standards that we develop. Ultimately, the devil's in the details in determining, as we do our evidence-based research, as we get feedback from the market, and as we identify the topics that are most likely to impact a company's performance, does it actually lead to better outcomes for companies. And it's impossible for us to say moving forward because SASB is still brand new. But if SASB had existed in the past, if we categorized companies' sustainability data as either consistent with SASB standards or inconsistent with SASB standards, what would the findings be? Well, there's been a few different attempts to answer that question. One of the most prominent ones was published in the Accounting Review a couple years ago, comes out of researchers at the Harvard Business School. They found that companies that performed well on the SASB topics outperformed their peers in annualized stock returns over about a 20-year period. And so we find that, and the fact that this finding is reinforced a few different times by more recent research helps give us confidence that in looking for the narrow set of issues that are most likely to impact a company's performance. If you think about the 80-20 rule, there's just about 20% of the sustainability issues that can have 80% of the impact, roughly. And that's our work, is to really zero in on that baseline set of material issues. And so I mentioned that this is going to be an ongoing process. These issues change over time. Sustainability in companies and investors in the markets more broadly are not stagnant concepts. And so we have a multi-year process to ensure that once we publish updates to the standards, we go back to continue research on areas where we have not formed a clear idea and go through all of the steps. And we are focused on being as transparent as possible, having public meetings, when we have comments, publishing those to the website, publishing our proposed changes to the website to get comments. All of that kind of lives on our website. So one of the things that I want to talk about in kind of this last 15 minutes or so is information that might be able to be incorporated and used in your classes. And so first I want to talk about, examples or potential case studies. And then second, I'll talk about different resources or ways in which you can use this if you'd like. So first, one of the most common examples that we see recently in thinking about how sustainability issues can have a financial impact is the recent case of Chipotle. I think it's certainly also very relatable to many students because it's a very popular brand. When they had their E. coli outbreak, it wasn't actually that it affected too many individuals, although one is more than enough. The bigger problem was that it outlined that the management of Chipotle's supply chain and how they source and secure their food along the production process to be able to deliver consumers had some serious weaknesses. And so their stock prices continued to suffer based on that fact. And it really all tied back to food safety. And when our restaurants standard, it's very clear that food safety can have a financial impact on companies' performance. And so we outline metrics that companies can monitor for their own performance, but then report publicly that investors can also use to be able to assess where there might be warning signs before something bad happens. Another kind of real-time case study looks at automobile parts manufacturers in 2009, I think in 2011, new rules came out related to emissions for certain auto parts in the trucking industry, and Cummins and Navistar are two of the biggest players in producing engines and other parts for large trucks. And they took a very different approach to meeting those rules. Cummins updated, used a new manufacturing process to update their entire engine line. Navistar primarily bought credits to be able to satisfy their requirements under the new rules. And partly that led to that different approach meant that Navistar ultimately got to a position where they couldn't continue buying credits. And whereas they used to be really a market leader, certainly in school buses, but that other trucks as well saw a continued decline over the course of several years, 2011, 2012, 2013, 2014, being unable to adapt their product offerings to comply with the new emissions requirements. And that has continued and lagged their peers, where the top two lines represent two of their biggest competitors, and the bottom white line represents Navistar. And how they manage their approach to these emissions rules has had a multi-year impact on their stock price and ultimately investor confidence in the company and their market share. And again, this sort of topic is reflected in the SASB standards, looking at fuel economy and use phase emissions for, in this case, the industrial machinery and goods industry. Looking at what are your fuel efficiency metrics on a sales weighted basis for medium and heavy duty vehicles, et cetera, et cetera. Another case study that's interestingly reshaping the entire real estate industry is how real estate companies are managing waste and water and electric use, and how that then leads to variable financial results and financial performance among their portfolio. And a positive sign was that one of the large real estate investment trusts, Digital Realty Trust, just a few months ago published a broad set of data on energy consumption, the percent coming from the grid versus renewable resources, water consumption, consistent with the SASB standards for the past 2 years in their most recent SCC filing. So you're starting to see movement away from, and there's still a long way to go, but this is kind of an interesting another case study as to how companies are starting to change the way they communicate these issues to the market. Because what you can imagine is that with better data, you can get better analysis for a company's price, where there might be a current stock value price for a particular company, but as you get more information about its greenhouse gas emissions relative to its peers, or its water management, or its workforce health and safety, you can negatively or positively adjust that price. And this is just a quasi-fictional, this is kind of taken from real data, anonymized, and kind of estimated for how an analyst might adjust a valuation based on different ESG data, to ultimately see that there can be a broad range, that if a company performs well, they might get revised up, but if they perform poorly, they can get revised down. And this big range of potential value that an analyst could make is what reinforces the importance of better data and standardized data in the market. So those are some case studies that kind of illustrate kind of the financial impact of sustainability. Now I want to point you to some resources and materials that we have on the SASB website that can help you even more concretely, to the extent that you want to incorporate some of this into your curriculum. So a very common starting point is the SASB Materiality Map, which if you just type SASB Materiality Map into Google, you'll be able to find it. It's also on our website under Materiality and Approach. And so this identifies our different sectors, and then within those sectors, what are the industries? In the healthcare sector, we have 6 different industries, and there's a lot of white space because fair marketing and advertising, or labor relations, has not been demonstrated to have enough evidence for material impacts in the biotech industry. But customer welfare and access and affordability and water management has. And so we shade in the topics that are likely have financial impacts, and then you can kind of click through and see industry and just industry by industry how different industries have different sustainability profiles. You also then can download the actual standards for those industries. This is also free. And the standards basically provide 3 pieces of information. They provide what are the topics like greenhouse gas emissions or air quality or water management. What are the metrics? What are the actual KPIs? Primarily quantitative, but about 20% are qualitative, like description of strategy is a qualitative metric. What are the metrics that an analyst or company can use to assess performance on that topic? And then what is the actual accounting guidance? What is the technical protocol? What do we mean by scope 1 emissions? What do we mean by flared hydrocarbons? What do we mean? What's it within scope? What part of your operations are considered? So the standards can provide a lot of detail for better understanding these issues. We also have a set of case studies that we've actually prepared. The ones that I kind of outlined just a few minutes ago are just kind of interesting sources of examples of financial impact of sustainability in the market. But we have asked investors to compile case studies of how they use the SASB standards in a range of different types of activities. So these are all available on our website under something called the ESG Integration Insights, which is a series of case studies published under that ESG Integration Insights title. We've got one from UBS thinking about how they incorporate sustainability into their fundamental analysis. We have one from Nordea looking at particularly emerging markets. And how sustainability and SASB standards gets incorporated into their use. We have one from Columbia Threadneedle, which has a whole dashboard of sustainability data where they start to rate companies based on sustainability performance and compare that to financial ratings. We have, so those were all kind of publicly listed companies. We also have debt and credit analysts looking at sustainability. We have a case study from Breckenridge, PIMCO. We also have it in private equity where a private equity firm is making investments or doing due diligence in potential new portfolio companies. Partners Group has done a case study there. And then we also have the big pension funds and foundations and asset owners who think about how they evaluate their money managers on sustainability. So we have a case study from Westpath as well. So those case studies can be, and those are available for free, a helpful resource to incorporate or reading to include in your classes. We also have a common activity that I've heard professors do is to kind of compare how companies are talking about sustainability publicly. And so we've had some classes that I know of that they have taken a look at a company's website, its SCC filings, its sustainability report, its annual report, which can be slightly different. Some of the materials they might post on their IR road shows. And so look at different ways in which companies communicate sustainability information and see, do they report anything on any of the topics in the SASB standards or other topics outside the SASB standards? What are the differences? Is there data? Is it kind of descriptive, but there's no actual data and it's more boilerplate? Are there targets and goals? And so look at how there's overlap or differences and how companies communicate this. And then we also have some resources that are available that come with a fee. Ira mentioned our SASB Alliance. We have a component of the SASB Alliance for educators, which is a $200 annual fee, where there's periodic news and research and information shared through a monthly newsletter. We have an educator portal where there's a sample curriculum that can be used. It's kind of a I think it's a 10-week or 12-week course. So you can use that as inspiration with readings and exercises and writing assignments. And then it also comes with the membership comes with discounts on other resources that we have. It includes access to our full list of publications that are not free. We have other research reports that are available through the SASB library. And then we have other kind of events, an annual conference, things like that. We also have a resource portal called the SASB Navigator, which includes all of the content and evidence behind the standards, and then an analysis of how companies are currently reporting this. We have some of the publications that are part of the SASB library include a guide for how questions that investors can use to ask companies about the performance. We've seen some professors use this in a slightly different way for their classes, thinking about how students might ask that of companies where they might want to work, or evaluate where they might add or change the questions that are included there. So there's a range of different publications in the SASB library, one of which is a look at the current disclosure of sustainability information, which can also provide interesting comparisons for how different companies report this information, industry by industry, where the blue represents that there is disclosure, but the different shades of blue represent that the type of disclosure, whether it's generic boilerplate or whether it's kind of goals and targets without performance data for company tailored narrative, or whether it's actually data for metrics, is all reflective in our state of disclosure report. And then we also have an educational credential, which about 600 folks, about 620 now, have signed up for, which is about 20 to 30 hours of independent study. We've seen a number of professors who have taken this course to then incorporate some of the learnings and teachings into their own curriculum and just for their own personal insight. And so there's two levels to that. If you want to take both of them, the first focuses on the core concepts in understanding sustainability and materiality, and the second looks at how walking through sample case studies of how sustainability information can provide a different analysis of a company's performance. So, oh, and I guess the last thing that is available, if your school and library has access to either a Bloomberg terminal or a Thomson Reuters platform, some of these investor services are starting to incorporate references to SASB, and you can see some interesting. We've had one class that has access to Bloomberg terminal for some of their students, do an analysis between what is the sustainability data in the Bloomberg terminal more broadly, and then looking at the SASB tagged Bloomberg data. What are the differences between the broad set of sustainability information and the narrower set? What is excluded that maybe should be included, and things like that. So that can provide an interesting exercise as well. So I think we're coming up on time. I haven't seen that any questions have come through, but Ira, is there anything that you have?
I thank you, Nicolai. That was a great presentation, not only on the SASB framework and basics and process, but we really appreciate your effort in tailoring the presentation to the needs of teaching faculty, which is SCC's target audience. The wealth of resources that you've alerted us to was just incredibly helpful. Much appreciated. There have been some questions that have come in. Some of them are return to the basics, and in the next couple of minutes, maybe you and I can work through these. Well, even in my introduction, I mentioned 77 industries. One of your later slides in the deck talked about 79 industries, and does that imply that there's still a rolling effort to add more sectors, or is there another wave coming? And if so, what are some of the other sectors that have not been included yet, but you feel confident will be included in the near term?
Yeah, that's a fantastic question. So we are in a period of transition where we started out with 79 industries. And so that's kind of the legacy language on my slide deck there. We are transitioning to 77 industries when the standards are published in August. Because we got feedback that two of the industries were just so similar, mainly telecom services and cable and satellite. Those two industries, it made sense to merge. Similarly, with biotechnology and pharmaceuticals, those industries have become almost one and the same often, and so we have merged those two industries. So there will be, over time, continued evolution to the industries. Probably not very often, but as new business models and new types of companies emerge, like we have an industry for e-commerce that many legacy industry classifications do not have because they were founded long before e-commerce existed. So we will continue to update as needed, but for now and for the foreseeable future, it's just 77.
Thanks for that clarification, Nicolai. Then there were a couple of questions, comments perhaps, that related to the what some would call the alphabet soup of sustainability disclosure and reporting. You did mention the Global Reporting Initiative in passing in your remarks, and one attendee wrote in saying that she was aware from some press releases that SASB and GRI are actually collaborating, and was wondering if you could say a bit more about that, assuming that that is the case. And another attendee asked a slightly different question that also implicates GRI, and he asked, assuming that materiality is the key indicator in your approach, should we assume that it means that SASB is solely concerned about the content of mandatory reporting such as SCC reporting, and really is not playing in the voluntary reporting game such as GRI? So I think you addressed that in part in your presentation, but I'll let you take another bite at that.
Yeah, I'm glad that that got flagged. So there's two kind of related questions. So the first is that to what extent SASB and GRI and others are collaborating. We absolutely are. One of the projects that's most challenging but important is doing an analysis of all the GRI reporting metrics, all the SASB reporting metrics. Where is there inconsistencies between them, and are those inconsistencies justified based on the fact that we're serving different audiences, or are they unnecessarily confusing? And when they're unnecessarily confusing or different, we are committed to finding ways to align them so that they become the same. So that's a kind of multi-month project that we've publicly committed to and are in the early stages of rolling out. Then there's other ways in which we're finding ways to collaborate. We will have the GRI at our annual conference this year. We'll be at their conference next year. There's some other events and ways in which we're planning on working more closely. But then there's the question of whether SASB is solely focused on SCC filings and GRI is focused on voluntary reports. It's true that SASB has done a really effective job for years at communicating that we're squarely focused on SCC filings, as a way to kind of clarify where we're different. But I think that it's become clear that we communicated that message so consistently and emphatically that it really overshadowed the broader message that is actually more consistent with our founding and with our conceptual framework, which is that SASB's standards are meant to support corporate communications to investors, and that an existing format for that are SEC filings, but there's also other formats and channels through which companies communicate to investors. And so that's really where we see our biggest difference with other initiatives that might be considering sustainability information that is not financially material per se, but that is important for employees trying to decide whether or not they might want to join a new organization or whether or not they feel engaged with and supportive of their company. Community members that live in a community where a company operates often depend on different types of information than strictly what is financially material. And so that's where there is some of the biggest differences between SASB's work and GRI or other efforts work, is that we're really focused on where is there a financial impact of sustainability and how can our work support financially motivated decision making. GRI's work is not strictly focused on financial decision making, but is also focused on a broader stakeholder set. There are some investors even that prefer the GRI approach because they consider a broader range of sustainability issues than just the ones that are financially important, and that includes some of the kind of sustainability or socially responsible investors who view our work as not going far enough. And they support both GRI and SASB for those two different purposes in that sense. So that's really, I think, the best way to understand the characterization of our work, and that's reflected in a joint op-ed between our founder, Gene Rogers, and Tim Moen from a year ago in terms of how the SASB and GRI are separate but complementary. And it's less so the specific reporting channel. We're seeing companies report with SASB standards outside of SCC filings, and that's perfectly fine as long as they use the same rigor and quality and oversight for collecting and reporting that data as they do for other data that they report to their investors. So hopefully that adds a little bit more clarity. It's not all about the SEC filings. It's really more about what's the audience and what's the kind of approach you use to reporting that information.
Yes, that was extremely helpful clarification, Nicolai. The final, let's call it a cluster of questions and comments that came in relate to your brief mention of a forward-looking research agenda. And I guess one basic question was, can you identify some of the open issues that might be on your research agenda going forward? A related point made by one attendee is in the same breath as thanking you for all these resources for educators, asking why can it not be a two-way street of educators also helping you, perhaps by providing case studies or other materials, and one person saying that can't SCC, the Sustainability Curriculum Consortium, facilitate that two-way street. So without putting you on the spot, I'll just ask you about the research agenda going forward, and if you see opportunities for partnering with faculty members who are also doing their research on related topics.
Sure. So one area of the research agenda that we're particularly mindful of is that human capital continues to be a difficult area where there's not always as much evidence about the financial impacts of some of these issues, and so that's an area where we find that it's going to continue to benefit us to do more research, and would love to see more research from the academic community. I don't know what else is going to be on the research agenda, but that is intended to be published in the fall, most likely, and so that can serve as a way to kind of guide, the next 3 years for some of the areas and hotspots that SASB is looking at. For case studies, we welcome professors, educators pulling together case studies that they see as useful for considering corporate management of these issues or investor analysis. And I've had a couple who have kind of suggested things along those lines. I haven't actually seen any that have been finalized or have been shared with me, but would love to see those as they develop, or I'm happy to kind of serve as a sounding board and think about how we can then share those further once they are published. So we certainly welcome efforts by SCC members to continue developing the materials in this space to highlight how sustainability can be managed by companies and analyzed by investors.
Excellent. I look forward to exploring that with you further, Nicolai. Perhaps we can create some sort of a process that feeds into the forthcoming research agenda. And let me thank you again for joining us today. It's always great to hear you present on the full breadth of SASB's activities. It really has been extraordinarily helpful for our audience. And I will be sharing your contact information with those who pre-registered. So if they want to follow up with you directly, they'll be able to do that. And the recording will be posted within the next couple of days. Again, for those on the line and listening to the recording, the SCC website is curriculum for sustainability.org. With that, Nicolai, thanks again, and we'll sign off for today.
Thanks so much, Ira. Thanks, everyone, and have a great day.
Bye-bye.